Most accountants think the lifetime capital gain exemption is a one and done deal. One sale, one exemption, and that's it. But what if I told you the best accountants are multiplying it and saving their clients millions in tax?
Hi, I'm Praveen Sidhu. I'm a Canadian CPA and have a specialty in advanced tax planning. I've completed the 3-year in-depth tax program through CPA Canada, and I've spent years helping businesses and professionals build smarter, more strategic tax plans. I create content that bridges the gap between compliance and real strategy. So if you're an accountant or advisor looking to level up your tax game, you're in the right place.
Quick recap. The Lifetime Capital Gains Exemption allows your client to shelter up to $1.25 million in capital gains when they sell shares of a qualified small business corporation. That's about $300,000 in tax savings, depending on the province. The Lifetime Capital Gain Exemption is governed under subsection 110.6(2.1) of the Income Tax Act, and it is one of the most generous tax planning tools in Canada. But most accountants just use it once and move on, and that's a big mistake. Here's the trick. The Lifetime Capital Gain Exemption isn't limited just to one person. With the right corporate structure, meaning multiple shareholders or a properly drafted family trust agreement, you can multiply the Lifetime Capital Gain Exemption across multiple family members. Each qualifying individual gets their own $1.25 million exemption. So, if the shareholder's spouse, adult kids, and a trust are all part of the plan, you can multiply that exemption. So, 1.25 million times 4, that's millions in gains sheltered and up to $1.25 million in tax avoided, depending on the province. This isn't just a theory. This is fully legal and happens all the time among wealthy families who structure their exits properly. So let's break this down visually. Scenario A, no planning. Your client owns a business valued at $5 million. She's the only shareholder, and therefore she has a lifetime capital gain exemption of $1.25 million and a taxable gain of $3.75 million. The estimated tax is around $900,000. One person, one exemption, one taxable bill. Now, scenario B. Your client freezes the growth in her current shares and issues new growth shares to the family trust. The trust holds these shares on behalf of her spouse, and her adult children, 2 adult children. So that's 4 beneficiaries times 1.25 of the lifetime capital gain exemption for each individual. That's $5 million tax-free. So tax paid, $0. Same sale, just completely different outcomes. Now let's talk structure. Here's what it actually takes to make this work. Step 1, the corporate freeze. Under Section 85 of the Income Tax Act, your client can exchange their common shares for fixed value preferred shares, locking in the current value of the business. This is called a freeze. Step 2, issue common growth shares. New common shares representing the future growth are issued to your client, and they will later be transferred to a discretionary family trust. So step 3 includes setting up a family trust. Create a properly drafted discretionary family trust. You have to name the trustee and the beneficiaries. So you'll name your client, their spouse, adult children, possibly a holdco as a beneficiary. So trusts are governed by common law, but for tax purposes, you have to pay attention to Section 104.1, which defines the trust, income, and beneficiaries, Section 74.1, which includes the attribution rules, Section 107 that outlines how capital property can be distributed on a rollover basis. Add a trust agreement, a trust resolution, and corporate minutes authorizing the freeze. This is why you'll need a lawyer for each of these steps so that the documents are drafted properly. This isn't about being aggressive or sneaky. This is smart, proactive planning, and it's how families keep wealth in their bloodline. Most accountants stop at filing, but the best ones become advisors, protecting intergenerational wealth and not just income. Tax season might be about compliance, but off-season is where the planning happens. So how do you actually implement this? How do you read the Tax Act to ensure that you're in compliance with the various sections that I named earlier? How do you do a Section 85 roller? What does a Section 85 roller mean? What other sections can I do this under? And what are the important things about a trust? What questions do I have to ask my client? That's exactly why I want to build a course where you can earn your professional development hours, but also learn about tax planning. So if you're interested, please subscribe to my channel, comment down below and tell me what you want to learn about, and I'll keep posting some videos and you can stay updated with all the tax knowledge. So if you're ready to go beyond tax returns and start offering real strategy, the course link will be offered in the future. And if you're not there yet, just subscribe now because I'll keep showing you strategies your client thinks that you already know. Smart accountants, they don't just file, they plan.